You're listening to the Stock Detective Podcast. I'm Kermit Capital. On this episode, Dhaval Kotecha interviews anonymous Twitter user 10K Diver. 10K Diver is known for their long threads on topics within investing and finance. You can follow them at 10K Diver on Twitter. Now, before we get to the episode, here's a quick disclaimer. This podcast does not constitute an offer of or solicitation for purchase or sale of securities or provision of any investment services. It is provided for information only and should not be considered as investment advice or recommendation to buy, sell, or hold a particular investment. You're responsible for your own investing decisions. All right, here we go.
You are listening to the Stock Detective Podcast. I am your host, Dhaval Kotecha, and today we are joined by a special guest, 10K Diver. He teaches finance and investing concepts via Twitter threads. I personally have learned a lot from him in the past few months. His Twitter handle is 10K Diver, and he is a must follow if you are not following him already. 10K Diver, thanks for joining us today. I'm very pleased to have you here.
Oh, thank you very much, Dhaval. For what it's worth, I think you're a must follow as well.
Thank you very much. So, to kick things off here, my first question to you would be to talk about what led you to where you are now and what got you interested in finance and investing.
Well, so I grew up in India, and when I was growing up, my dad was very interested in investing. So he would constantly be reading several business newspapers and magazines and so on. And he would constantly be following what's going on in the stock market. And, there's always CNBC would be playing in the background and so on. So from my dad, I sort of got the lesson that learning to invest and saving, so saving and investing are both sort of very important. But unfortunately, I didn't actually learn anything beyond that. I learned how important it is to save and invest. But if you had asked me the ABCs of investing, I wouldn't have been able to tell you. And then in 2009, I came to the US, and I joined a PhD program in the US. And I did a couple of internships here and there. And once I did some internships, I got some money. And I thought to myself, okay, maybe now is a good time for me to get into investing as well. I had already learned from my dad the importance of investing. I just knew nothing about it. So I got a subscription to the Wall Street Journal, and I read this wonderful book by Roger Lewinstein, which is Warren Buffett, the making of an American capitalist. And I also read The Intelligent Investor and so on. And that got me really interested in the basics of investing. And it's always great when I have any questions or anything like that, I could always call my dad and ask him, look, I don't understand this particular topic, or I don't understand stock buybacks or something like that. And he would spend time explaining the basics to me, and that sort of helped. Um, so yeah, that's my route to investing.
Great. So I'm also from India, but I don't have any finance background myself, and it's just good to be connected to folks like you and learn from you guys on a daily basis. So I found you through Twitter, and I see that you create those Twitter threads every weekend. And I also see that every Twitter thread starts with get a cup of coffee. So I am curious to know what is the reason behind that and what got you started with those Twitter threads.
Right. So I did some reading, and I understood this topic in investing called the Kelly criterion. And so I decided to make a thread about it on Twitter. But this was not so. Usually, when you uh, go through Twitter, there is this tendency to look at each tweet and then keep scrolling, right? But this was not a topic that people could just scroll through. This required, a certain amount of attention from the reader. So if the reader had to understand this particular topic from me, I would need the reader to spend about 10 minutes or 15 minutes uh, to concentrate and try to understand what I'm saying instead of just scrolling through their feed to the next one. So at the start of the thread, I wanted to tell the reader, look, if you want to come back to it later, you can come back and so on. But if you want to understand what this thread is about, you need to spend the time. uh, and I wanted a nice way to say this. And I thought, okay, settle down, get a cup of coffee, and let's explore this topic together. That seemed like a good way to do it. And so that is how this get a cup of coffee got selected, got started. And then from the next week onwards, I started writing these regular threads because the first thread was very successful. Um, the first thread was successful mostly because it caught the attention of another account on Twitter called Borrowed Ideas, and he retweeted my thread, and so it became very successful. And once I saw the power of this this medium, this thread, in that particular weekend, I got about 2,000 followers or something like that. And I thought, okay, fine, this thing has real power. Why don't I try to write a thread every week? And so next week, again, I'm there. I have this topic and I have this thread. And again, I want to tell the reader, look, this is also something that you have to sit down and spend the time to understand. And I'm a computer scientist by training. And when a computer scientist solves a problem, they try to reuse it again and again. They don't like to solve the same problem twice. So the previous week, I had already solved this problem of how to tell the reader that this thing requires a certain amount of time and concentration. So I just reused the same solution. I said, get a cup of coffee again. Uh, and before you know it, it sort of became my signature on Twitter.
Absolutely. And I'm glad that you kept continuing making those threads, because I, like many others, look forward to those threads every single weekend.
Oh, thank you very
So,
much.
yeah. So, next up in this segment, 10K Diver is going to deep dive into 10K of none other than, and most appropriately, one of the most famous coffee chains in the world, which is Starbucks. So, what I will do is I will hand it over to him to take it over from here.
Okay. This podcast is being made available on both on audio and on YouTube. So I have a bunch of slides in front of me, but I will try to um, narrate them in such a way that even those who don't have access to video, who are maybe listening to the podcast when they're driving or something like that, should be able to catch on. Uh,
Excellent.
so to do a deep dive of a 10K, what I'd like to do is I'd like to sort of split this deep dive into three parts. The first part actually doesn't even have anything to do with the 10K. It has to do with this website called QuickFS, which is which is really a wonderful website, which gives you several years worth of financials for a particular company. And what I have started doing is before reading the 10K, I just like to go to QuickFS and pull up this particular company's financials, and then sort of scan the financials for interesting tidbits, important points, and so on. And then once I know roughly what the finances of the company look like and so on, I will then go and read the 10K. And the my browsing of QuickFS would have already told me what are the things to watch out for and what are the things I need to learn more about the company and so on. So when I go through the 10K, I will go through it with that sort of a mindset. So that's the first part of this deep dive. Um, just looking at Starbucks on QuickFS and trying to come up with a bunch of questions we want to answer when we go through the 10K. Then the second part of this deep dive is to go over the main sections of the 10K. So there are four main sections in a 10K. That's there's the business description, then there is the uh, risk factors, and then there are the financials, and then there are the notes to the financials. So those are the main sections of the 10K, and then we will sort of talk about how to look at each one of those sections. And then the third part is actually analyzing the 10K, because the 10K will give you some information, but very often the information that you really want is not available in the 10K directly. It's available indirectly. You have to sort of pull up the numbers and take a number on page 50 and divide it by some other number that's on page 85 and something like that. You have to do some calculations by going through the 10K back and forth. And so you sort of have to piece together this information from various parts of the 10K. And with a chain like Starbucks, one important thing that we want to understand is what does the economics of a new store look like? How much does it cost to set up a store? And then once you set up the store, what do the cash flows of a store look like, and things like that. Um, and Starbucks has been the second thing is that Starbucks has been spending a huge amount of money on repurchasing shares in the last few years. And so one of the questions while answering while going through the 10K is, have these repurchases actually been effective in terms of reducing the share count and so on. And the third thing is that Starbucks, in order to fund these repurchases, they have gone and borrowed a huge amount of money. And whenever you have a company with a large amount of debt, as Starbucks has now, you sort of have to understand what is the schedule of the debt and what is the interest and interest rate they are paying and so on from the 10K. And so these are all questions that we want to answer by piecing together information from various sections of the 10K. And so that will be the third part of this deep dive, how to do this basically. Okay, so the first part, I want to give a shout out to this website, QuickFS. It's just quickfs.net. And if you pull up Starbucks on this website, um, you will find that they give you access to there is an overview page which gives you some important financial information about Starbucks. And then there is also they also give you the income statement and the balance sheet and the cash flow statement and so on. So all this data typically for the last 10 years or so is available on QuickFS, and it's available for free actually. If you create if you just create an account which is free, QuickFS will give you all this. And I believe if you subscribe to their paid service, you can get quarterly information in addition to the annual information. But for us, I think the annual information is more than enough here. Okay, let's just take a look at the income statement of Starbucks on QuickFS. Of course, the first line in the income statement is the top line, the revenues. And QuickFS, if you go to QuickFS right now and pull up Starbucks, they have the financials from 2011 all the way to 2020. And we can see that in 2011, Starbucks had revenues of about $11.7 billion. And in 2020, Starbucks had revenues of about $23.5 billion. Um, Now, 2020 is affected by COVID, as we all know. So if you just compare 2019 to 2020, you'll see that there's a drop in revenue, there's a drop in gross profit, there's a drop in operating profit and net profit, and everything has basically worsened simply because of the COVID lockdowns. So 2020 is a very it may not be a year that represents normal earnings power for a company like Starbucks. So if you stop at 2019, for example, if you go from 2011 to 2019, what we see is that revenues for Starbucks have gone from $11.7 billion in 2011 to about $26.5 billion in 2019. So that's like 11.7 to 26.5. So revenues have more than doubled. In fact, if you divide one by the other, you see that revenues have become 2.26 times. So the 2019 revenue is 2.26 times the 2011 revenue. Then the other line you can look at is the net income. So what was the net income in 2011 and what is net income in 2019? It turns out that even though revenue grew by 2.26 times, net income actually grew by 2.89 times. So this immediately tells me that this business has some economy of scale going on, some operating leverage, because revenue has grown, but the growth in net income has outpaced the growth in revenue. So there is some element of scale in this business, some operating leverage. And so when we go through the 10K, we want to try and understand that a little bit more detail. The other thing is, even though net income has grown by 2.89 times, if you look at the net income per share, that has grown by 3.6 times. So when net income grows by a factor of 2.89, but net income per share grows by a factor of 3.6, it means they've been buying back shares. And if you look at the number of shares, you can see that just between 2015 and 2020, the number of shares has gone down from 1.5 billion shares to 1.2 billion shares. So that's like a one-fifth reduction in the share count. So the share count has gone down by about 20%. So they're doing a lot of buybacks. And the other thing that I want to point out is that if you look at the net interest income, which is basically interest expense for Starbucks, in 2018, QuickFS says that Starbucks actually had net interest income of $21 million. They had income of $21 million, whereas by 2019, that income of $21 million has become an expense of $234 million. So when there's such a big change in your interest payments, interest expense, that usually means that the company has taken on a huge amount of debt. And in 2020, their interest expense, QuickFS says it's $397 million, which is even higher. So that means they have, in just the last 2 years, they have been increasing that debt load by a large amount. we know that interest rates today are at rock bottom, and a company like Starbucks can borrow a huge amount of money at a fairly low rate of interest. So if you see interest income shoot up like this, it probably means that they have taken on a huge amount of debt. And that's definitely of interest when we go through the 10K. So the other thing that we can do is quickly look at the balance sheet, which will clearly tell us whether they've taken on debt or not. So if you look at the long-term debt line item on the balance sheet on QuickFS, we see that in 2020, Starbucks had a debt of about $14.6 billion. This is a huge amount of debt for the company. The company's earnings last year in 2019 were about, I think, $3.6 billion. So this is like 4 to 5 years worth of earnings in debt. This is a huge debt load for the company. And if you take a look at shareholders equity, which is basically all the assets the company has minus all the liabilities, that shareholder equity was positive in 2018. But because they took on so much of debt, and used the money to go and buy back shares and retire them. So now they don't have the cash anymore because they borrowed money and then used it to retire shares. Um, so their assets remain roughly the same, but their liabilities have gone up big time. And so shareholders equity is actually negative for this company. Their total liabilities actually exceed their total assets. So that is another thing that we want to look at in the 10K. And finally, when we pull up the cash flow statement on QuickFS, I like to look at depreciation and compare it to property, plant, and equipment expenses. So depreciation is a non-cash charge, which is charged by a company um, because it spent money in the past opening new stores and things like that. Whereas additions to property, plant, and equipment is the amount of money that they are spending today opening new stores and things like that. And it turns out that for Starbucks, in most years, they have capital expenses, which are additions to property, plant, and equipment. The capital expenses exceed the depreciation charge. So for example, if you look at 2018, for example, their depreciation expenses are $1.3 billion, but they spent $1.9 billion or almost $2 billion in capex. And this probably means that they're opening a bunch of new stores. That's why they're reinvesting all this money back into the business in the form of property, plant, and equipment. So since they're investing money back into their own business, opening new stores, we sort of, when we go through the 10K, we sort of have to understand what's the economics of a new store. So what we just got from looking at QuickFS for a few minutes is we want to understand revenue growth. So remember that revenue grew by a factor of 2.26 or something like that in the last 10 years. We want to understand where that revenue growth comes from. Does it come from just the company opening new stores, or does it come from each individual store doing better, doing more sales than what it did in the previous year? So where is the revenue growth coming from? So if the revenue growth comes from new stores, if the company is opening a lot of new stores, that can explain some of the capital expenses that we saw on the cash flow statement. And if there is revenue growth that's coming from same store sales growth, which is basically our existing stores selling more, then that might explain some of the operating leverage that we saw in the income statement. So we want to look at both these parameters. Then we want to, of course, understand the store economics, the return on invested capital when it comes to opening a new store. Then, of course, we want to understand the buybacks in a little bit more detail, because they've been borrowing a huge amount of money and using it all to retire shares, to reduce the share count by that 20%. So we want to understand that in a little bit more detail. And because they've been borrowing a huge amount of money, we want to understand their debt structure. What are the debt maturities and what interest rate are they paying, and basic things like this about their debt. Okay, so that is a wrap on part one. So part two is the main sections of the 10K. So as I said, the 10K has got 4 main sections. The first section is the business section. So if this is usually the first section of a 10K, it will describe the business. So for something like Starbucks, it's a fairly simple business. So it's just a few pages. They will tell you, basically tell you that they sell coffee, and they'll talk a little bit about how they have segmented the business into for example, the American segment versus the international segment, and so on. So since Starbucks is a large company, it organizes its business into multiple segments, and this section in the 10K will describe these segments to you and give you more details and so on. The second section of the 10K is the risk section. It'll list all the risk factors. So what the lawyers like to do is they like to they like to list every possible risk factor that can possibly cause a shareholder to lose money if they invest in Starbucks. It's a good idea to read through the risk section as well, just to get a feel for what are all the various exposures the company has and so on. Then the third section of the 10K are the financial statements. So your income statement and balance sheet and cash flow statement and so on. So QuickF has already provided us with a sort of a snapshot of these statements, but the 10K will have many more details. And the fourth and most important section is the notes to the financial statements, where so your consolidated balance sheet or your consolidated income statement will have a bunch of line items, and each line item there are some assumptions behind the line item. So for example, if the balance sheet has a certain amount of debt, there are more details behind the debt. So for example, how do they obtain the fair value of the debt, and are there any covenants that are part of this debt, and things like that. So the notes to the financial statements basically give you far more details about each line in the financial statement, which so they give you more color and help you understand the business a little bit better. Okay, so if you look at the 10K, the 2019 10K of Starbucks, the first section, as I said, is the business section. This section is only about 7 pages long, so it's not too long at all. And because it's not that long, I usually read the section fully. And even though we think we all know how Starbucks makes money, it's still a good idea to read this section because it will tell you how management views the business, and what are the growth areas that they see in the future, and how they have split the business into multiple segments and so on. So for example, in the case of Starbucks, Starbucks has this deal with Nestle. Nestle and Starbucks have some kind of a partnership where Nestle uses its distribution network to distribute Starbucks's products and things like that. So even though we may think that we know about the business, it's still a good idea to read this particular section, because it can teach us a lot of new things that we wouldn't have known otherwise. So with Starbucks in particular, one thing that is very clear from reading the business section is that management looks at the stores that they have through two different lenses. So the first lens is a geographic lens. So how are the stores distributed across the world? So how many stores do they have in America? How many stores do they have outside the US, outside the Americas, the US and Canada, and so on. Um, there is that lens, the geographic lens. The second way to slice and dice the stores is to look at how many of the stores are operated by Starbucks and how many of the stores are operated by licensees. So Starbucks has something like a franchise agreement. So for example, if you go to a Starbucks in India, for example, there's a very high chance that that Starbucks is not actually operated by the US Starbucks. What Starbucks has done is it's something like a franchise where they've given the franchise to an Indian company, which is allowed to operate with the Starbucks name and sell coffee. But that would not be a company operated store. That's what is known as a licensed store. So management looks at the store footprint of Starbucks through these two lenses: company operated stores versus licensed stores, and also the geographic lens, the stores that are in the US and the stores that are in Canada and the stores that are in China, and so on. And that is very clear when you read the business section of the 10K. The business section also gives you more details about how the stores are distributed across the world. So again, if you look at just the stores operated by Starbucks, the company, so not considering the stores that are licensed to others, just the stores that are operated by the company. If you look at the 10K, it tells you that the US is by far the largest, has the largest store footprint. So there are about 8,800 stores in the US, 8,800 Starbucks locations in the US that are operated by Starbucks. The But the thing is, the number of locations in the US is not growing very fast. So there's a large number of locations, but the number of locations is not growing very fast. If you want to figure out which country has the fastest growth, that is clearly China. So I said the US has 8,800 stores. Well, China has only about 4,000 stores. So that's less than half the number of stores that's there in the US. And we have to remember that the Chinese population is much larger than the US population. So per capita, the number of stores in China is far lower than the number of stores in the US. But still, when it comes to growth, it is the Chinese stores that are growing much faster than the US stores. So the Chinese stores are growing at something like just last year, for example, they added about 600 stores in China, and when the total number of stores is just 4,000, adding 600 stores is like that's like a 15% growth, right? So the growth is much faster in China, but the existing store base is much bigger in the US. And the other thing is, if you look at the licensed stores of the company, you will find that there are 0 licensed stores in China. So the company has licensed stores all over the world, but not in China. In China, what the company did is they converted all the licensed stores into company-operated stores. So every single store in China is company operated, and they are investing a huge amount of money in China, trying to set up these new stores and trying to grow the store footprint in China at a very rapid pace. So that sort of tells us that there must be something here. So the future of Starbucks um, is uh, is the future of Starbucks in China. And so we sort of have to understand what are the economics of a new company operated store in China. What is the return that Starbucks can get uh, when it opens a new store in China? So that's something that's very clear from reading the business section, that this is going to be this might be the single biggest factor that's going to affect the future of Starbucks over, say, the next 10 years or 15 years. So we are now done with the business section. The next section in the 10K is the risk factors. And here I have a confession to make. I don't really read all the risk factors in their entirety. Uh, that's because the risk factors are written by lawyers for lawyers. So they will list all kinds of risk factors that are perfectly obvious. So, for example, they might say, uh, you know, if our stock price goes down, then that is a risk to shareholders, or something like that. Yes, everybody knows that. So I don't really read all the risk factors in detail. But the nice thing is that usually in a 10K, the risk factors will be organized into subsections, and each subsection will have a heading that is in bold. So what I do is I read the heading of each subsection, and then if that's a risk factor that I want to know more about, then I read the subsection fully. But if I read the heading and it says something like, if the US economy slows down, then we will also slow down, or something like that, then that's perfectly obvious to me. I don't really spend a lot of time reading that subsection. I just move on to the next bold heading. So this is how I go through the risk factors. Uh, but of course, I want to stress that we have to think deeply about the risks that are facing a business. So, for example, if I have to ask myself, okay, what is the biggest risk that Starbucks is going to face over the next so many years? Um, I would say that it's brand value erosion. So Starbucks has a wonderful brand in the eyes of consumers, and I mean it's why people are willing to pay $5 for a cup of coffee. Uh, it- they have this powerful brand, and in many parts of China and India and places outside the US, uh, a cup of coffee at Starbucks actually costs a significant amount. In the US, it doesn't. I mean, relative to the earnings power of people and so on, it may not be that expensive. But outside of the US, uh, a cup of coffee at Starbucks is something like a luxury, and so uh, I would say that if something happens to the Starbucks brand, if they don't advertise properly, or if they don't maintain this aspirational status in the minds of consumers across the world, that would be a big risk. And there are a lot of companies who once had a very fine brand, and then they let it erode over the years. And so I would say that more than any competition or anything like that, I would say that this is the biggest risk for Starbucks in the long term. In the short term, of course, there are there's COVID and things like that. But assuming that those things get solved eventually once a vaccine arrives and so on, I would say this is the biggest risk to Starbucks from a business standpoint. From a financial standpoint, I would say that their huge amount of debt is a risk, and so the problem is that when you have a huge amount of debt on your balance sheet, you become very fragile. So Starbucks had no idea that COVID was around the corner when they took on all this debt, but now uh, when you have a quarter with where your same store sales has declined by 30% or whatever, having so much of debt on the balance sheet looks like it may have been a mistake. So the debt is a financial risk to Starbucks. So what I want to say is that we have to think deeply about what are the risks that can potentially derail this company as an investment if we buy shares and hold them for the long term. But those risks, they may or may not be listed on this list of risk factors that's there in the 10K. It's this list of risk factors is great. It's useful, but it's not a substitute for thinking deeply about what are all the risk factors and risk exposures the business is going to have over the next several years. So the last two sections of the financial statement, the last two sections of the 10K are the financial statements and the notes to the financial statements. And here there is this beautiful Buffett quote where Bob Woodward from the Washington Post one day asked Buffett, can you teach me how to be a good investor or something like that? And Buffett said, look, you're an investigative journalist. You already have all the skills that you need to be a good investor. So the idea is that when you look at a 10K, you have to approach it like how an investigative journalist or an investigative reporter approaches a problem. So what they would do is you assign yourself a story. So for example, the story might be how does the economics of a new Starbucks store look like? And then you go around, you try to gather enough information from the 10K, look at various sections and try to put all this information together to try and answer this question with the available information that we have. So that comes from not just reading the 10K, but also going through the financials and the notes to the financials in detail, and then thinking about them, trying to see whether you can tease out this kind of information. And if you can't, how do you gather additional sources of information that can help you answer these questions and things like that. So that's what Buffett meant by saying, think like an investigative reporter, assign yourself a story, and then try to read the 10K and then get the answers to the story. So that is exactly what we are going to do now with Starbucks 10K. So we are going to assign ourselves two stories. The first story is what does the economics of a new store, new company operated store look like, because the company is opening new stores and operating them throughout China. So we want to understand what the economics of that looks like. And the second story has to do with the buybacks. They are spending a huge amount of money on buybacks, and is that really benefiting shareholders or not? So these are the two stories that we have sort of assigned ourselves, and we now have to go through the 10K and try to answer these questions, or try to find out how these stories unfold. So the first story, of course, is the new store economics. So when Starbucks opens a new store in China, what does the economics of a new store look like? Well, the first thing is that Starbucks has revenues across multiple stores, and if you look at the income statement will tell you what is the revenue that Starbucks had in aggregate across all the stores. But the business section already gave us the number of stores they had. And in fact, they gave us the number of, the business section gave us the number of stores they had in various parts of the world, separated geographically and separated according to whether it was a licensed store or a company operated store, and so on. So the first idea is that if you take the total revenues of Starbucks and then from the income statement, and then divided it by the number of company operated stores from the business section, this will tell you what is the revenue per company operated store. And the thing here is that if you look at Starbucks, the income statement reported by Starbucks, that income statement, it clearly breaks out how much of the revenue came from company operated stores and how much of the income, how much of the revenue came from licensed stores. So it's very easy to figure out what is the revenue per company operated store. So what I have done is I have gone through not just the 2019 10K, but also through each of the 10Ks from 2009 to 2019. For each of these 10Ks, I got what is the revenue, total revenue across all company operated stores, and then the number of company operated stores. And I could divide one by the other, and then I'm able to tease out what is the revenue per store. Now it turns out that in 2009, the revenue per store was a little less than $1 million, so about $0.93 million. That was the revenue per store. But that was in 2009. If you look at it in 2019, that number has grown from 0.93 million to about $1.36 million. So that translates into a growth of about 3.87%, roughly 4% per year. That's the same store sales growth. So if you have a store, it's the average store was growing its revenue at a rate of about 4% over the last 10 years. And it's because of this same store sales growth that Starbucks has some scale and operating leverage. So anyway, so we have this revenue per store, which is $1.36 million. The next question, of course, is how much does it cost to set up a store? So we have this store, and once we set up this, once Starbucks sets up this store, they are able to get $1.3 million per year in revenues from the store. But how much does the store cost to set up in the first place? Now, this is a tricky question. This doesn't, the 10K doesn't quite break out this number. It doesn't tell you, okay, this is how much a new store costs. So the first clue is that we have to look at CapEx, because Starbucks, when they spend money setting up a new store, what they do is they incur capital expenses, and then those capital expenses are depreciated over the life of the store. So whenever Starbucks spends money setting up a new store, they incur CapEx. So the first clue is that this CapEx can tell us something about how much it costs to set up a new store. But the problem is that this CapEx is not specific to new stores. So if you look at Starbucks has got a huge store print all over the world. So they have to constantly keep renovating existing stores as well, not necessarily just opening new stores. So they're going to spend a huge amount of money every year renovating existing stores and maybe buying new espresso machines for existing stores and so on. And all that also counts as CapEx. So we know what is the total CapEx that Starbucks spends, but we don't really know how much of this CapEx is going towards renovating existing stores and how much of this CapEx is going towards opening new stores. See, that is what we have to try and answer for ourselves. And one clue is that if you look at the amount of depreciation that Starbucks charges every year, um, that is approximately the amount of money uh, that they will spend on renovating existing stores. So, for example, if Starbucks spends, say, you know, $1 million renovating a particular store, and they depreciate that over 10 years, what it means is that on average per store, it costs about 100K to sort of renovate the store, right? Because it's 1 million over 10 years. So this depreciation can serve as a useful proxy for how much money is spent on renovating existing stores. So you have capex, which is the total amount that is spent on both renovating existing stores and constructing new stores. And then you have depreciation, which is approximately the amount of money that is spent on just the renovation part. So if you take the difference between the two, the capex minus the depreciation, that gives you a very rough idea of how much money do they spend setting up new stores. And then we know how many new stores they set up, because every 10K tells us how many stores they had, right? So in any given year, if you take the previous year's 10K and this year's 10K and figure out how many stores they had the previous year and how many stores they had this year, you can tell how many stores they have added, right? You look at how much money they spent, which is the capex minus depreciation. That is the amount spent on opening new stores approximately. And then we know how many new stores did that money buy Starbucks. And so if you divide the amount of money spent in opening new stores, if you divide that by the number of new stores that are opened, that is roughly the amount of money it takes to open a single new store, right? So this is fairly imperfect. There are a lot of underlying assumptions here. So the biggest assumption is that depreciation expenses are approximately equal to the maintenance capex, and any capex that is above this goes towards growth. But if you do this assumption, if you make this assumption, then you can sort of try and tease out how much money it costs to set up a new store. And if you do this, it turns out that in various years from 2009 to 2019, it costs so some years it looks like a new store doesn't cost very much at all, but in some years it looks like it costs a lot of money. So just to be conservative, because this calculation is essentially imperfect, right? So we just take the highest number. So from 2009 to 2019, so for example, in 2012, I think it costs about $740,000 to set up a new store. But if you look at 2019, it looks like it costs only $320,000 to set up a new store. Now, which one is right? Is it $320,000 or is it $740,000? That we can't really answer. But if we want to be conservative, we have to take one of the higher numbers. We have to assume that a new store will cost 740K. And then if it is 320K, that's great. Our analysis has been erring on the conservative side, which is fine. So if you look at the total, if you look at all the years from 2009 to 2019, the maximum amount of money which we think a new store costed is about 860K. So let's just assume that a new store takes 860K of initial capital to set up. Okay, so we are going to assume that Starbucks, it costs Starbucks 860K to open a new store. And then once the new store is opened, that store makes about $1.36 million of revenue in its per year. The other thing is when Starbucks spends this money, this 860K in opening a new store, uh, the question is, how long will this money last Starbucks? Because uh, you know, let's say they buy some store decorations and furniture, and they set up the IT equipment and computers and security cameras and the coffee making equipment and refrigeration refrigerators and so on. This is all part of that 860K goes towards all this. But these assets, they don't last forever, right? They last only for a certain amount of time. And so we have to figure out uh, how long these assets will come for, because that is the useful life of the assets. And once these assets have served their useful life, then maybe Starbucks will have to put in another 860K to renew these assets and keep the store going. So the 860K will last only for a specific amount of time. And how long is that time? And this can be estimated by going to the notes in the notes to the financial statement. Um, so there's something called property, plant, and equipment gross of depreciation. So when a company depreciates its assets over time, what happens is there is an initial cost of those assets, and then after depreciation, there's the carrying value of those assets. So if an asset initially costed say $1 billion, and over a period of time, let's say uh, uh, the asset has been depreciated by say $200 million, then the asset will be carried on the company's books at $800 million, because the original cost is 1 billion, and uh, there's 200 million of depreciation that went into the asset. And so now the asset is carried on the balance sheet at 800 million. But what we want is, what is the original value of the asset? What is the 1 billion? So how much was initially spent on setting up this asset? And that information can be obtained from the notes to the financial statements. So it's not available on the balance sheet itself. It's only available on the notes. The balance sheet will tell you how much the asset is carried for, how much the asset is carried on the books at, but it won't tell you what was the original cost and how much was the depreciation usually. And that is provided only in the notes to the financial statement. Okay, so why do we need this information? So there is this gross of depreciation, the how much the asset costed. Because if you take the depreciation expense that Starbucks is charging, and if you find out what is the original cost of the asset and how much are they depreciating it, that those two pieces of information together will tell you what the useful life of an asset is. So for example, if an asset costed $5 billion, okay, and depreciation on the asset is $1 billion per year, then you can say that okay, this asset has a useful life of about 5 years, right? Because 1 billion per year for 5 years is equal to $5 billion. So that's exactly the same principle here. So you take the property, plant, and equipment, the gross before depreciation, and you take the depreciation figures and then try to figure out what is the useful life of the assets that Starbucks has. And if we do this, this number remains fairly consistent from 2009 to 2019. It doesn't really change that much. It's roughly about 10 years. So Starbucks is when Starbucks spends that 860K opening a new store, that store it has a useful life of about 10 years. So for the next 10 years, whatever money that store makes, that is what the output of the store is for this initial investment of 860K. Okay, so just to recap, what we have so far is Starbucks spends 860K to set up a store. Okay, this is the cash that goes into the business. Then there's no need to touch that for 10 years because this 860K will buy assets that will last for 10 years. Then what happens is every year for these 10 years, the store will make annual revenue of about 1.36 million. That is our revenue per store. But of course, there are going to be costs as well. It's all this revenue is not profit for Starbucks because when they sell coffee, they have to spend money employing people in the store, and they have to spend money on the milk and the coffee beans and so on. So Starbucks has all kinds of costs as well. So if they have a $1.36 million revenue per store, how much do they actually make in profits from the store for this 860K investment? That's what we want to answer. And so for that, it's fairly simple. So what we need to do is we have to look at how much cash the store is able to generate. So for this, what we need to do is we take the total operating expenses of the store, and then we from the operating expenses include depreciation, but we are only interested in cash expenses at this point because the depreciation is to compensate for this 860K. We have already taken the 860K into account, so we don't have to take another depreciation in future years. So what we need to do is we need to figure out what is the cash that is thrown off by a store. So we take all the operating expenses, not counting depreciation, and we also take the interest expenses to be conservative because the store, this 860K is probably financed by debt. So the debt is Starbucks has to pay interest on the debt. So if you take all the operating expenses net of depreciation and add interest expenses to that, this all information comes from the income statement. That tells you what are all the expenses the store will have. And we already know that the store is going to have 1.36 million in revenue. So you take the revenue and then you subtract out all these expenses. That is the amount of cash that is thrown off by the store every year. So if you actually go through the 10K and fill in all these numbers and do the calculation, it turns out that out of that $1.36 million of revenue, Starbucks gets about 250K in operating cash flows. So that is the amount of cash that is thrown off by a store each year. So how does this investment look like? You spend 860K initially setting up the store. This 860K creates a store that will last for 10 years. And then for each of those 10 years, you get 250K back from the store. So that's like putting in 860K and then getting back 2.5 million, 250K per year times 10 years. That's 2.5 million. So this is what a store's economics looks like. And if you want to calculate the IRR of this sequence, which is 860K in and then 250K out for 10 years, that IRR turns out to be about 26%. So that is the return on invested, return on incremental invested capital that Starbucks has from a new store from a new company operated store that they open. Of course, there are a lot of assumptions that went into this calculation, and so Starbucks may not have exactly 26% return on incremental invested capital, but I think this is a reasonable estimate for how much money Starbucks makes per dollar that it reinvests back into the business. And this 26% return on invested capital is actually very good for a company of Starbucks size. To be able to reinvest capital at such a high rate of return by opening new stores in China, it's actually very, very impressive. And one thing is we assumed that this 250K a store is going to throw out cash of 250K per year over 10 years. But as we have seen, Starbucks is actually able to grow its store sales at 4% per year, right? That's the same store sales growth. So that 250K, it may be 250K in the first year, but it might grow at 4% for 10 years. So in that case, the return will be even better than 26%. And our 860K itself was a fairly conservative assumption. A new store may cost only 750K for all we know, uh, because of that maintenance capex versus growth capex, because we made conservative assumptions there. So this 26% return is actually a reasonably conservatively calculated figure, and it looks very good for a company like Starbucks. Okay, so that was our first story that we assigned ourselves. What is the new store economics? What do they look like? And we have sort of answered the question saying that they look reasonably good. The second story is this huge amount of stock buybacks that Starbucks is doing, and so we have to sort of figure out how effective are these stock buybacks, because they're spending huge amounts of money buying back their stock. And they have ramped up the stock buyback program in the last 2 or 3 years. Um, so whenever a company spends a lot of money buying back stock on the one hand, what we have to do is we have to make sure that they are not just turning around and issuing those shares back to um, the employees and the CEO and senior management on the other hand. Because if they do that, then they're on the one hand they are buying back stock, and on the other hand they are diluting existing shareholders by issuing stock, and that's not a good thing, and that actually hurts shareholders. And if you look at any company, almost every company I know outside of Berkshire Hathaway, maybe, when they do a stock buyback, they always tell you, "Oh, we returned $10 billion this year to shareholders via stock buybacks." But did they really return $10 billion back to us as shareholders, or is it more like maybe uh, $5 billion? Because if they spent the 10 billion retiring, say, 100 million shares, but then they went and issued 50 million shares back, then the full impact of the 10 billion doesn't come back to us, right, as shareholders. On the one hand, yes, they did retire a lot of shares, but then on the other hand, they issued those shares back uh, as stock options and so on. And so now we are left with this problem of trying to calculate, even though the company says they returned 10 billion to shareholders, how much did they actually return? And for that, we have to look at the notes to the financial statements. And in the notes to the financial statements, Starbucks, in the case of Starbucks, it happens to be note 11 on the 10K. They tell us exactly how many shares they bought back and how much they spent on buying back these shares. So, for example, they say that they repurchased 139.6 million shares at a cost of $10.1 billion in 2019. And in 2018, that it was 131.5 million shares at a cost of 7.2 billion. So they tell you how many shares they repurchased and how much they paid to repurchase these shares. So what we can do is we can figure out from the notes to the financial statement, the company tells you how much money they spent on repurchasing shares and how many shares they bought back. But the number of shares that have been reduced, the share count reduction, may not be equal to the number of shares they bought back. And frequently, the share count reduction is smaller than the number of shares they bought back, because they are also simultaneously issuing stock to executives. So how do we find out how much of stock they issued? Well, that is very simple. At any given time, we can tell how many shares of the company are outstanding. And that information is provided in the consolidated statements of equity, the shareholder equity statement. So if you look at the shareholder equity statement, that will tell you how many shares are outstanding at any given point in time. So now we have two pieces of information. So the company is telling us how many shares they bought back, and then we can see how many shares are outstanding. And so if we correlate these two pieces of information, we can tell how much of the stock buyback has actually gone towards retiring shares and how much of the stock buyback has gone back just to offset the dilution that is created by issuing stock options and RSUs to the executives of the company. So if we do that, uh, we see that over the last 4 years, I did this exercise for the last 4 years because that's when the company did the maximum amount of buybacks. So throughout 2016, 2017, 2018, and 2019, the total number of shares that the company said they repurchased is 343 million. So they said they repurchased about 343 million, which I got from the notes to the financial statements. But then if you take the number of shares outstanding and figure out how much has it decreased over the same period, uh, that reduction is only 300 million. So they said they bought back 343 million worth of 343 million shares, but the share count has reduced only by 300 million. So that means their buybacks are only about 87% effective. So for every 100 shares that they said they bought back, they actually issued 13 shares and gave them back to executives. So they actually ended up retiring only 87 shares out of those 100 shares. And this is actually not bad. For most companies, this ratio, if you calculate it this way, is actually much worse. So for a lot of companies, especially the tech companies, they're diluting their stocks so much like crazy by issuing all these RSUs and stock options to executives that if even though they may be spending billions on buybacks, half of that or more than half of that just goes towards offsetting the dilution. And in Starbucks' case, only 13% of it goes to offset dilution. The remaining 87% goes towards actually retiring shares, which is a good thing. But of course, there is one thing here, which is, as Buffett always says, a share repurchase for a continuing shareholder makes sense only if the shares are bought at or below intrinsic value. And you can argue that Starbucks is buying back shares below intrinsic value, or you can argue that the shares are being bought back above intrinsic value. So I'm estimating the intrinsic value of Starbucks is not something that we are doing here. But I just want to say that whatever buybacks they are doing, the shareholders get 87% of the benefit of those buybacks. Now, if those buybacks are done above intrinsic value, that's not great for shareholders, and if they're done below intrinsic value, that's great. Uh, but even if they are done below intrinsic value, only 87% of the benefit goes to shareholders. And compared to most other companies, 87% is not bad at all. So the last thing we should look at is the debt that the company has. So remember that I said they are able to do all these wonderful repurchases only because they've borrowed a huge amount of money. So they are not funding the repurchases from the cash from operations. What they've done is they've borrowed a huge amount of money and then immediately turned around and bought shares from the money and retired those shares. So whenever a company borrows a huge amount of money, we have to sort of figure out what is the schedule for paying it back. And that information will also be provided in the notes to the financial statements. So if you look at the long-term debt that Starbucks has, so this particular information, I looked at the 2020 10K, which just came out last week. I haven't had the time to read it fully. So most of the other analysis in this particular podcast episode was done using the 2019 10K. But just for this, I took the 2020 10K because these guys, they issued a large amount of debt in 2020. So if you look at the debt, there are some portion of the debt is due in 2020 itself. There is some portion of the debt that's due in 2021, and some of it is due in 2022, and so on, all the way up to 2050. So they have actually borrowed money in 2020, which they need to repay in 2050. So this is just, I mean, this is very, very long term debt. And at first glance, it looks like they've been able to get a reasonable rate of interest on this debt. This has been a bit of a surprise to me because the balance sheet for Starbucks already has so much of debt, and they've actually raised additional debt, and still they managed to do it at a pretty reasonable interest rate. So the interest rate is about 2, 3, 4% per year. They have a large number of different bond offerings, and they all have different interest rates. But all the interest rates look fairly reasonable. It's like they borrowed money at 3.5% interest, which is not due until 2020. And so that's not bad. So normally I don't like companies that have a huge amount of debt, because debt makes a company very fragile, and we all want anti-fragility. But if you're going to have some debt, the best kind of debt to have is low interest debt, which is not due for a very long time. So Starbucks seems to have done that part of it reasonably well. But if you look at just the next 5 years, so they have a total debt of about the I mean, this particular 10K says that they have a debt of about um, $16 billion, and about $6 billion of it is due in the next 5 years. Um, so if you look at the debt that is due in the immediate term, meaning in the next 5 years, um, there's $6 billion of debt that is coming due, and they already have $4.3 billion of cash on hand, which is a good thing, as long as they don't burn through that cash. So we don't know how long COVID will last, and whether they'll be operating at a loss for the next quarter or two, and if so, will they burn through the cash or not? But they have $4.3 billion of cash on hand. And their normal earnings power, I would say, is about 3 to 4 billion per year. That's the net income they make in most years. Not during this COVID period, but in 2019, for example, they made about $3.6 billion in net income. So they have $6 billion coming due in the next 5 years. They have $4.3 billion of cash on hand, and their normal earning power in a normal year is about $3 to 4 billion. So it doesn't look crazy. But then again, if there is an extended lockdown because of COVID or something like that, then we sort of have to monitor the situation and see whether this debt is actually serviceable. Although I think compared to a lot of other companies, Starbucks is not, it's not terribly positioned. But as I said, it's far better to not have much debt on the balance sheet at all.
That was an excellent deep dive. Thank you very much for explaining how to read a 10K in this level of detail.
Oh, thank you very much, Dhaval.
So, moving on, I have a few questions for you.
Okay.
And
For the benefit of the two listeners who are still with us.
Yes. uh, s- so, um, w- if the markets were to shut down for the next 5 years, which one stock would you be willing to own and why? And that can be Starbucks because we already talked about it. So you had to pick one other stock apart from Starbucks, and
Okay.
give me a stock that you are going to own for the next 5 years if the markets were to shut down.
Right. So if the market is to shut down tomorrow, I will have no hesitation owning Berkshire Hathaway for the next 5 years. Uh, the reason is simply because of the financial strength that Berkshire has. They've got a huge amount of cash. What is it? $140 billion on the balance sheet.
Yes.
Um, they don't have any options or stock-based compensation or anything like that. That's crazy. They've got a whole bunch of diversified earning streams. So um, if the stock market is to suddenly shut down, trains are still going to be running across America. BNSF is still going to be carrying uh, uh, freight across the country. And the utility operations are still going to be running. People are still going to be using electricity. Uh, Maybe
And
the high frequency traders won't be using the electricity because the market is shut down. But everyone
people are
else
going
will
to
be
be
using.
people are going to be using iPhones as well, right?
Oh, I think so. People are going to be using iPhones. Maybe not to pull up stock quotes, but for everything else. Um, and people are going to be driving around. If the market is shut down, you know, a lot of us on FinTwit have nothing to do all day, so we might make long trips, and using our for that we need Geico's insurance, and
Right.
we might be eating a lot of sea candies and so on. Who knows? This actually sounds pretty good if the market is closed for the next 5 years.
Excellent. So, moving on to the next question. Do you have any book recommendations? Do you want to talk about at least one key takeaway from that book, or like maybe why you are recommending that book?
Right. So I'm going to cheat a little bit and recommend more than one book. So I already talked about Roger Lowenstein's excellent book, uh, Warren Buffett, the Making of an American Capitalist. That was the book that I sort of first read when I got into investing, and uh, well, that and Peter Lynch's book. Those are the two things that I read. But for anybody who's new to investing, I definitely recommend Roger Lowenstein's book. It's called Buffett: The Making of an American Capitalist, and it just chronicles so beautifully, from when Warren Buffett was a young child. I mean, he was delivering newspapers, and his sort of dedication to his craft was apparent even at that age. So most people, when they deliver newspapers, they would just deliver the newspaper and go on, right? But one of the stories in this book is that Buffett would actually go and look at all the houses where he was not delivering newspapers, and he would go and figure out, just by looking at the magazines that were on their front door, he would sort of figure out when their magazine subscriptions were expiring, and then he would maintain a list of whose magazine subscription is expiring on what day, and then he would go just before their subscription expired. He would go and try to convince them to sign up with him for the magazine. And this all kinds of interesting anecdotes like this, and it's just a wonderful book.
Great.
The other book that I would recommend is called Fortune's Formula. This is a book written by William Poundstone. And see, I love stories about people finding arbitrage opportunities. And this book has to do with how a large number of different people in different fields, from horse racing to blackjack to options trading, how a large number of people have found arbitrage opportunities in various fields and then taken huge advantage of them. It's a wonderful book.
Thank you for sharing your knowledge and the book recommendations. So, as a closing note, final thoughts, and do you have any advice for new investors tuning into our podcast?
Um, well, for a new investor, uh, the only advice I have is always think from first principles. So, what I mean by that is, if you buy a stock, say, um, you spend a certain amount of money buying the stock, right? And you have to think about the cash flows that the company will return to you over the life of your investment. That is very different from using a formula based approach. So using a price to earnings ratio or a price to book ratio or an LTV to CAC ratio or one of these things. So the financial literature and the financial jargon is full of all these little uh, tips and tricks. Just use this ratio or that ratio or something like that as a substitute for actually thinking about a business and doing the valuation. So, what I would say is, sit down, think deeply about a business, and figure out how the business makes money, figure out how much capital has to be invested, what is the cash inflow, what are the cash outflows, and so on, and make your decision based on that. Don't rely on some formula or some ratio or something like that, because these things they may work for a while, but then eventually, if there's an opportunity uh, to take advantage of a particular ratio, there will be people who take advantage of it. And so the first principles thinking, buying a dollar for 50 cents, that is never going to go out of fashion. But all these ratios, which are sort of a proxy for intrinsic value, they come and go all the time. Sometimes they work and sometimes they don't work. So don't get hung up on any one uh, key performance indicator or metric like this. Just any company that you're analyzing, think about it from first principles. That would be my advice to new investors.
That's excellent advice. I wish I knew about that when I started investing, because
I
I
wish I
used
knew
to
about
get
that too.
hung up on a lot of these things when I began, and I thought, okay, I should be focusing on all of these before I buy a stock, and that was probably not the case. So, um, as you know, like at the end of every podcast, we love to give shout outs to folks on Twitter. And just because Kermit is not there in this episode, what I did was I asked 10K Diver to give a shout out to one of the persons from Twitter along with me. So these are our shout outs. I am giving shout out to Brian Faroldi. His Twitter handle is at Brian Faroldi, and his Substack is brianfaroldi.substack.com. He is one of my favorite people on Twitter. He's also one of my most bookmarked follows. And I've been following him for almost like a couple of years now via like Motley Fool podcast, and now also on Motley Fool Live. And I've learned a lot from him over the years, and I admire his investing process, like his checklist and stuff. And I keep learning every day from what he shares via his tweets, Substack, podcasts, and Motley Fool Live. So I highly, highly recommend Brian Faroldi to all our listeners here. So do you want to go ahead and talk about borrowed ideas?
Sure. So I'm giving a shout out to mostly borrowed ideas. The handle is at borrowed underscore ideas. Um, I know this guy. I've had detailed conversations with him, and during my initial days at Twitter, when I had no followers, even then, borrowed ideas has always been very supportive, very encouraging, and he's always in any way possible he has tried to help me and tried to uh, help me understand things. So I don't really understand growth businesses, like for example, Amazon or Facebook or some of these companies. I don't quite understand I understand the business, but I don't quite understand how the valuation for these businesses are so high. And after reading borrowed ideas, some of the threads written by him, he's got a beautiful thread on Facebook, and he's got some beautiful threads on Amazon. I'm able to sort of appreciate what other people see in these kinds of businesses, and I've learned a lot from him, and he's a wonderful person. So and he responds to all his if you DM him, he usually responds very quickly, and so on. So he's just a great guy to know and a great guy to follow.
Absolutely, and I would second that. He is definitely highly recommended from my side too. And like he has his website mbi-deepdives.com. I highly recommend everyone checking that out. His deep dive on Etsy was phenomenal. Like I own Etsy, and I read his deep dive on it, and it was awesome. Very well detailed, and I would highly recommend Moral Ideas. That brings us to the end of the podcast. Thank you very much, 10K Diver, for joining us today. I'm
Thank you for
sure
having
a
me.
lot of people have learned a lot from this discussion. Thank you very much.
Thank you.